We're diving into a financial analysis report today. It's titled Huge Financing Secured, What the New Deal Means for DVLT Shareholders.
Right, the Data Vault AI deal with Silex.
Exactly. A super complex $150 million strategic financing deal. And what's interesting is the payment in Bitcoin. And of course, the massive shareholder dilution that came along with it.
Yeah, that dilution is really the headline here.
It is. And that brings us to our first point, which is really about the structural choices. In this analysis, the report, it does a good job detailing the mechanics of this financing. But to really maximize the impact, the information needs to be resequenced.
Okay.
You have to immediately connect the cost of the deal, eye-watering dilution, with the benefit of the capital.
I see what you mean. I found the deep dive into the transaction mechanics really fascinating, but I agree the structure needs a rethink.
How so?
Well, the way it's laid out now, you have to sort of wade through all the complexity, the payment method, tranches 1, tranche 2, the Bitcoin transfer, before you get to the punchline.
Before you get to the severity of the dilution.
Exactly. We know Silex got 279 million shares through common stock and these pre-funded warrants. And that basically tripled the share count.
Yeah.
That's the critical fact, the immense cost. And right now, it's buried. It's buried deep inside the procedural details in Section 2.
I can kind of see what they were thinking. Establish how the money was paid before you reveal the consequences. But in a high-stakes analysis like this, no.
No, it's backwards.
The financial shock has to come before the procedural description. You have to establish the sheer scale of the dilution first. That way, the reader frames the rest of the report as this massive trade-off, not just some, corporate update.
I totally get the instinct to detail the how. But the report's main job is to tell investors how their ownership stake just changed drastically.
Right.
So we need to elevate that consequence, bring it right to the top of the deal structure section, establish that double-edged sword idea immediately. Huge capital injection, but at what cost? The dilution isn't just a detail, it is the story.
So hit the reader with the trade-off first. Okay, so how do we translate that into some concrete changes for the report itself?
Well, for one, instead of leading with the closing dates and the exact number of Bitcoin, Section 2 needs to start right away with the total value, the $150 million, and the total equity issued.
That massive 279 million shares?
Yes. Put those two numbers side by side. It creates this immediate, almost visceral comparison point for any shareholder reading it. That shock kind of validates why they need to read the rest of the report so carefully.
And then you take all those procedural steps, the closing dates, September and November 2025, the exact count of 1,237 BTC, and you relegate them.
Relegate them to a supporting subsection. The main takeaway is the ownership change, not the closing conditions.
Yeah, that makes sense.
And to really make it stick, you could refine the language. Introduce a clear verbal device, something sharp, that summarizes the whole deal.
Like a tagline for the deal itself?
Exactly. Something like, this deal is defined by 279 million reasons why existing owners own less, paid for by 1,237 Bitcoin. It's punchy. It communicates the severity and the unique payment method all at once.
I like that. That structure forces the reader to immediately calculate their own potential loss before they even start thinking about the company's new capital.
It maximizes the impact.
Which is what you need with something this complex.
It ensures the reader doesn't miss the forest for the trees. The Bitcoin payment is interesting for sure, but the dilution is existential, and the structure has to reflect that.
Okay, so once we've framed that financial cost, let's pivot to the strategy, this big bet on AI and Web3.
Right.
The report does a great job highlighting the strategic pivot to a Web3 AI hybrid with a focus on real-world asset tokenization. But where I think it could be stronger is in linking the financial risks of their treasury strategy to this new business model.
That's a really critical point. The current analysis, it talks about Bitcoin volatility risk in Section 3B, but it treats it mostly as a standard balance sheet issue.
Like a simple correlation. If crypto markets go down, DVLT stock might follow.
Yeah, exactly. But the weakness is that it doesn't really explore how that treasury strategy might compound the risk, especially given their new business direction.
It feels like it misses that systemic link. RWA tokenization. You're converting tangible assets, Tanzanian minerals or whatever, into digital tokens. That whole process, it demands a foundation of stability, of institutional confidence.
Precisely. And the report notes that DVLT is kind of doing the MicroStrategy play, holding a huge chunk of their corporate treasury in BTC.
A very volatile asset.
A very volatile asset.
So the vulnerability here is this dual exposure. You're holding Bitcoin while also relying on blockchain for your core revenue through RWAs. Is there a risk that the Treasury's volatility undermines the very stability you need to launch these RWA platforms that depend on trust?
The report makes a strong case for the $150 million war chest being a good thing, a necessary thing. But we need to strengthen the counterargument. Make it clear this isn't just a balance sheet risk, it's a strategic credibility risk.
Yes, we need to bolster the bear case by really analyzing that systemic link. We should be asking, does the volatility that comes with a Bitcoin treasury undermine the trust you need to onboard partners, especially for something like healthcare data monetization, which is part of this Silix deal?
I think the key question is, will the market see this as strategic brilliance or just a high-stakes gamble? A concrete way to frame this in the analysis could be to pose a really sharp question.
Like what?
Something like, does the focus on this Bitcoin treasury distract from or maybe even negatively impact the $10 million licensing deal for sensitive healthcare data where stability and trust are, everything?
That's a fantastic lens. Healthcare data, digitized minerals, the kinds of RWAs are talking about need perceived financial stability to attract serious institutional money.
Of course.
So we should explore that scenario. What happens if a sharp crypto downturn hits? It would hurt DVLT's book value, and it would probably kill investor appetite for these new RWA ventures at the exact same time.
Creating a brutal feedback loop.
A feedback loop where a market risk becomes a fundamental strategic failure. The report has to spell that out.
So what's a concrete way to phrase that in the analysis?
You could suggest an inclusion for Section 4 that asks, is there a risk the market perceives the 150M war chest as a large, volatile bet on Web3 and crypto, rather than the stable funding required for supercomputing and data monetization? That elevates the whole critique from a simple risk mention to a much more sophisticated strategic question.
I like that. Okay, let's move to the conclusion. The report finishes with what is, essential advice. Watch Silex's filings closely.
Which you absolutely should.
Absolutely. But we can make that so much more actionable by giving the reader concrete, measurable thresholds.
Yeah, I agree. The general advice is sound, but the distinction it makes between Silix holding their shares, which is good, and selling aggressively, which is bad, it's just too subjective.
What does aggressively even mean?
Exactly. The weakness is that a reader needs quantitative triggers, something that signals a real change in institutional intent. We need to turn this from a qualitative warning into a high-utility monitoring tool they can use right now.
Yeah, for sure.
We have to provide specific, actionable numerical indicators they can track using public filings. That's what elevates a report from just summarizing the past to actually providing tools to navigate the future.
So defining selling aggressively is where the rubber meets the road. I think we should suggest two clear paths for monitoring this. First, the regulatory path.
Okay.
Suggest tracking the 13D or 13G filings and setting a definitive threshold that's tied to their controlling stake.
That's a strong anchor point. So, for instance, you could say, if Silix reports selling an aggregate of 5% of the total issued shares, which is what, about 14 million shares?
Something like that, yeah.
Within any 60-day period, this should be considered confirmation of significant liquidation pressure. That 5% number is tied to a regulatory trigger, so Silix would have to file an update. It gives the market a clear, unambiguous signal.
That's a hard, actionable number. The reader knows exactly what to look for.
And building on that, regulatory filings can lag. So since Silix owns this massive 279 million share block, you can also monitor daily market volume. It's an earlier, more accessible signal.
Right, volume gives you real-time data. So what kind of volume threshold would suggest they're really starting to unload?
I think we should suggest tracking the proportion of shares being sold versus the total daily volume. So an indicator to monitor would be something like Silix selling consistently accounting for over 20% of the daily traded volume for 5 consecutive trading days.
5 consecutive days.
Yeah. That kind of sustained supply signals a deliberate effort to generate cash for their other operations, not just, routine portfolio trimming.
That gives the market a quantitative warning flag. It turns the general advice into a clear signal you can act on immediately.